think it also affects the actual decisions they've been making in that we're in a situation where the growth is solid. Financial conditions actually have been a little softer, which is appropriate given the information we have. But the key is that, in fact, the Federal Reserve, we have a lot of theory about this, says that when you're actually in a low interest rate environment where you're near what we call the effective lower bound or the zero lower bound, that you do want to act aggressively, but not to things that might happen, but to information that tells you should act.
Actual data.
Data, well, not just data. It can also be information about what's happening in the geopolitical front, because most of the uncertainty right now is in terms of what's going on in terms of the trade war.
Trade deal.
We just had this. We just had this issue of really an active war against Saudi Arabia, but we don't know how this is going to play out. The trade war could actually disappear very quickly. You know, this is something I think that Trump would like to have happen, and who knows whether things are bluffs or not bluffs or whatever. And I think that what the Fed needs to do is to make clear how we react when data comes in the future. And in fact, some central banks do this and do it quite well. The Fed has been extremely disappointing on this. One of the reasons why that's so helpful is because the markets will then do your work for you. That even before you act, if in fact the data comes in a certain way, the markets are going to react and lower interest rates for you.
How does the Fed communicate this without boxing themselves in?
Well, so this is actually something I've done a lot of research on. So the key is that you have to give scenarios and describe what you think you're going to do. And also, you can actually, you don't want to have to say that we have a rule that we're going to do something, that as information comes in, you have to explain it. And say, for example, let me give you an example. At the very outset of the financial crisis, the Fed completely shifted the way it was doing policy. So when, starting in September of 2007, with a situation where we had very strong growth, inflation rising, the Fed actually started to cut rates. What would have been even more helpful then is if it indicated that the reason it was doing so was because of the new information that a financial crisis might be imminent, and if it got worse, they would do more. Then, in fact, even before the Fed had to act, if in fact there was weakness out there indicating the financial crisis was getting worse, the markets would have cut rates for the Fed. And in fact, that actually produces exactly the kind of expectations that you want to stimulate the economy at the right time, even with the Fed not acting yet, but of course they will eventually do so. So in a sense, the key here is you want ammunition to move because we are in a situation where interest rates are low. So we actually want to keep that ammunition there, but then say we're going to act very quickly once we have some information that tells us we should. That would actually calm the markets. They would know more. Yep. It would actually increase the credibility of the Fed. The markets are not happy with the way the Fed is communicating. And I think it would actually lead to better policy. And I think some of the dissents, for example, I know Eric Rosenberg very well. Eric is somebody who thinks about these kind of things. I think part of the reason why he would rather them not move now is because he wants the ammunition. But in fact, if data starts to come in, including not economic data, but what's going on in politics, geopolitical data, that then the Fed should act very quickly. Remember that Eric and I were among the biggest doves during the financial crisis. So he could dissent, I couldn't, because you will almost never see dissents from governors, because it then reflects a lack of confidence in the chair, which could happen, but you don't want to do that. And certainly when Ben Bernanke's the chair, you have confidence, because Ben was extremely good. So I think that the issue here is that it's really all about the communication baby. That's really what the issue is.
You're also saying the Fed needs to be very aggressive, just not yet.
Yes.
They need to somehow communicate.
Absolutely. So part of this gradualism, I think, which is a very strong tendency, and it's because you're presiding by committee, there are times when, in fact, that's not the way to go. And particularly in an environment where you have less ammunition, you want to show that you're really getting out the big guns and getting out the machine guns when the time is right.
That's right. And one of the problems with gradualism is if you gradually cut interest rates and everybody waits for lower interest rates before they act. So the gradualism actually counteracts that's why the Fed can be powerful in a financial crisis, because it can shift sentiment by making a dramatic move, and you want to have the ammunition to be able to do that. But I realize that they're getting a lot of incoming from the administration. But if they think the right thing to do is to stop in October or stop now, they need to let us know that. And if the market throws a bit of a tantrum, then they just need to put up with it, because that's how you assert your authority.
There's been a school of thought that they hiked too many times last year, and they need to undo that to uninvert the yield curve.
I don't think that's correct. I think that there is an issue, which, in fact, again, the Fed's not emphasizing quite enough, that they're focusing on saying where the economy is, and that's why we're acting. The inflation rate is really the key picture. So what is so important, what we know that central banks can do and really should need to focus on is how do we do two things? One, keep inflation under control, and even more importantly, inflation expectations under control. And indeed, this is one of the reasons why Trump's saying they should go to zero interest rates.